What is a bank? A bank is a financial intermediary that accepts deposits and channels those deposits to leading activities, either directly via loan or indirectly through capital marketing.
Loans can be used to achieve major financial goals, such as buying a house or a car. They can also help you get through college.
Banks save money by law to make sure that people that put money in their bank get their money back.
A good way to achieve your financial goals is by saving up and having a plan. And by the end of every month, save up a little till eventually you will have enough to buy your financial goal. Saving is income not spent or deferred consumption. Methods of saving include putting money aside in a bank or pension plan. Saving also includes reducing expenditures such as recurring costs. In terms of personal financing, saving specifies low-risk prevention of money as in deposit account versus investment, wherein risk is higher. There is some disagreement about what counts as saving. For example, the part of a person's income that is spent on a mortgage loan repayment is not spent on present consumption, therefore is saving by the above definition. Even though people do not always think of repaying a loan as saving.
Example of RON required a start system when this skeet could be switched out when no longer needed. Mobile banking is a system that allows customers of a financial institution to conduct a number of financial transactions through a mobile device.
A certificate of deposit is a time deposit, a financial product commonly sold in the United States by banks, thrift institutions, and credit unions. CDs are similar to savings accounts in the fact that they are insured and thus virtually risk-free. They are, as some would put it, money in the bank. In the USA, CDs are insured by the Federal Deposit Insurance Corporation, FDIC, for banks, and by the National Credit Union Administration, NCUA, for credit unions. They are different from saving accounts in that the CD has a specific fixed term, often monthly, and usually a fixed interest rate. It is intended that the CD be held until maturity, at which time the money may be withdrawn together with the accrued interest. A secured loan is a loan in which the borrower pledges some asset, an example, a car or property, as collateral. A mortgage loan is a very common type of debt instrument, used by many individuals to purchase housing. In this arrangement, the money is used to purchase the property. The financial institution, however, is given security, a lien, on the title to the house, until the mortgage is paid off in full. If the borrower defaults on the loan, the bank would have the legal right to repossess the house and sell it to recover sums owing to it. In some instances, a loan taken out to purchase a new or used car may be secured by the car, in much the same way as a mortgage is secured by housing. The duration of the loan period is considerably shorter, often corresponding to the useful life of the car. There are two types of auto loans, direct and indirect. A direct auto loan is where a bank gives the loan directly to a consumer. An indirect auto loan is where a car dealership acts as an intermediary between the bank or financial institution and the consumer. Unsecured loans are monetary loans that are not secured against the borrower's assets. These may be available from financial institutions under many different guises or marketing packages. Often could be credit card debt, personal loans, bank overdrafts, credit facilities or lines of credit, corporate bonds,